Hello, welcome to this new video look ahead for Trade Zone. This is Ashraf Laidi. This is for Trade Zone for Eightcap. What I'm going to do in this video, I'll try to summarize what I'll talk about in 30 seconds. Okay, so first of all, euro dollar is looking very bullish. Things are looking very bullish here after two things last week. One was I wouldn't call it a pivot FOMC decision, but pretty clear assertion that rates are not going to be raised again, even though they said we cannot keep the door open for raising rates in the US, but it's a question of even though we are far away from cutting rates, we're not going to be raising them, so that really propped indices and weight on the dollar. So that's number one. Number two is the sort of weak payrolls, but more importantly, the rise in the unemployment rate in the United States, and are we getting close to that 4% level? So these two things, I would say that there is three things. You have to be cautious, but there has to be a third thing that really give us the green light towards this big thing called the seasonal rally. Okay, as you can see here, November's for the Nasdaq. Look at that, 1, 2, 3, 4, 5, 6, and you can go on and on. So the last 14 out of the last 15 Novembers were positive, and December is also quite positive. And so there is that seasonality, sort of seasonality here that you could say basically November into December, it's bullish for gold, for the euro dollar, and bullish for the S&P and for the Nasdaq. Okay. So basically, this is going to be quite positive for November and for December. All right? So the way that I'm thinking about this is that because the CPI is November the 14th, which is next Tuesday, not this Tuesday, I would say that's probably this week will be quite positive for equities, bullish for the euro up until next week. And this is the way I am looking at it. There's many ways of looking at it. There's a good friend of mine here who's Yanni, who specializes in indices. He pointed this out to me, which is basically said, if you look at the yields, at the 10-year yields, as they pushed up here, there is some sort of a cycle. So it looks like the real peak, we did not hit it already. Probably we're going to have one more peak, probably next week. Okay, so this could actually mean that we would probably push higher, and it won't be until next week where yields definitely will put in a peak, and then they will start to come down. You remember last year when the Bank of Japan intervened on October the 21st, that coincided with the peak in the bond yields. But let's look at this chart here in the euro dollar, which is basically, you can approach it from many ways. Very similar here to some sort of inverted head and shoulder here, or here, or here. And if you look at the difference here between the head 104.50 and the neckline, the next target is going to be around 108.10, 108.20, which is really a key confluence here. So, for those guys who are looking at this video and they're saying, I don't care about the indicators, I don't care about 3 days from now, just tell me if there is a quick trade. Well, it seems that we are on our way to go towards 108, so I would say conservatively 107.90, 107.80, but 108 is a key confluence. The yellow is the 200-day moving average, and the green is the 100-day moving average. And you really cannot take these things lightly. Euro dollar is probably one of the most liquid instruments out there in any market segment. Okay, euro dollar pair out of the currency market takes around over 26-27% of the turnover in the spot foreign exchange market. And when you have something on the daily chart, on the 100 and the 200, this is really important, what everybody's looking at it. And if you don't really, if your approach is not towards moving averages, then you look at this pattern here, okay? And so this is what we think we could be heading in. Now, for those of you who see this and are going to say, oh, this is great, I'm going to buy. Well, if you're going to buy, you are around 50 pips away from a key target, but you're also but you're also around 50, or well, actually 80 pips away from the support. So from reward to risk ratio, it's not really ideal. And one of the things that if you want to get into a trade where the reward to risk ratio is not your ideal 2-to-1, is not your ideal 3-to-1. Let's be realistic. Many of us went into a trade, a reward to risk ratio, where we probably planned 2-to-1 and we end up going 1.5-to-1 or 1-to-1. So this would be similar to that sort of 1-to-1, or if you really discipline yourself, okay? So that's an example. Let's just have a look here. Oh, as far as the indicators, as far as the data, again, this video is supposed to tell you what are the key indicators for this week. Well, there are no major indicators. The major one is next Tuesday, but as far as the regular indicators that everybody needs to pay attention to, every Thursday, jobless claims, this is really key. By the way, if you're listening, if you're in Europe, the time schedule for the U.S. indicator has gone back to normal because the U.S. has gone have got out of daylight saving time, so they too have reduced 1 hour. So that means that the major indicators are going to be at 8:30 a.m. Eastern Time, which means 1:30 p.m. London/GMT or 2:30 p.m. Dubai or 2:30 p.m. Central European Time. Okay, 1 + 4, that's 5:30 p.m. Dubai time. Okay. I'm just reading a headline here. Yellen and China Vice Premier to meet in San Francisco November 9th and 10th. Well, here you go. So towards the end of this week, Janet Yellen, the former head of the Federal Reserve, the Treasury Secretary of the United States, said she's going to be meeting the Vice Premier of China in November 9th and 10th. So that's important. When people hear these news, it's more leaning towards a risk on, okay? But so let's just talk about indices here, which is really, really key, okay? Now you've got the NASDAQ here. You've got the S&P, and you've got the Dow Jones, okay? So Dow Jones, there was something very interesting here. So before I talk about, well, the obvious, before I talk this very important gap, which is basically 4400 is really your key resistance for the S&P, okay? But before you look at it, we know that this past, let's say, from November of last year, when indices started to rally, November of last year to July, the big outperformer was technology, was NVIDIA, was AI. Okay, so NASDAQ went up the most. So NASDAQ is the one that went farther away from the 200-day moving average. Then you have the S&P. S&P went above its 200-day moving average, but it didn't rise away from its 200-day moving average as much as the S&P, as the NASDAQ did. And then you have the Dow, who just finally, just last week, broke above the 200-day moving average. But what is more important is that all three of them, especially the Dow, finally broke above the trend line, above the 200-day, but it still hasn't broken above the trend line resistance. Now, we have to be careful here. A lot of people are saying, listen, Ashraf, this is more than just a gap. This is more than a just 200-day moving average. This is more than, 2 consecutive weekly gaps. What has happened last week was a sea change in liquidity, in market expectations. What happened last week was a huge green light for risk on, because the Federal Reserve came in and they told us that, they pretty much told us that they're going to stay on hold. They justified why they're staying on hold. And the data that 2 days later, the job report, some sort of a slowdown, and it justified that. For me, I just need a third confirmation. And maybe by the time we get a third confirmation, we will have a bigger rally. But my third confirmation is really important, which is next Tuesday, next week, which is the 14th of November, and that's the CPI. Why? Because there is a small risk that CPI, or there's a headline, it could come back up higher than expected, maybe because of oil, okay, maybe because of a few things. But there is also something else that I want you to have a look at. If you look at So here, this is the banking index, the regional bank index. It just gapped up and it just went powerfully up last week. The S&P is still below the, it still has to test 4,400, okay? But what we're seeing is that metals are rallying and the dollar is falling. But let's go back here. This is what we are talking about. Now, here. You see this? This is the S&P, or US 500 if you're trading CFDs. And this is what you need to look at, is that, first of all, you see this gap here. This gap is not going to be considered to be filled. It's not going to be considered to be filled until we break above its higher boundary, which is, what is the low? It is 4401. So 4401, 4400, 4402, sort of 4402 is considered as a gap resistance. Also coincides with a trend line resistance, which also coincides with the 100-day moving average. So, ladies and gentlemen, from three different schools of, call it technical analysis, call it anything you want to call it, but from three different level of confluences, it is the high here, it is the gap, and it is the 100-day moving average, and you can say it is a trend line, so it's four. But let's just be careful about the gaps here. What I mean by the gaps, oftentimes, is that we break above a gap for one day, and then we don't have a confirmation, and then we come back down. So basically, ladies and gentlemen, if you want to have, if you're looking for the ultimate green light for the rally that gets you started for this time of the year, because apparently they say that, well, statistically, from November until April, November until May, it's a preferred time of the year, statistically, or time period for indices. So, but we really need 4,400. And from me, my question, ladies and gentlemen, is that from now until CPI, would we have risen, would we have rallied towards 4,400, okay? So once again, so by Tuesday, the 14th, would we have broken above this quadruple confluence, the trend line resistance, the top of the gap, the 100-day moving average? It says here 55. 55 DMA is the 43.45, okay, which we broke already on Friday, okay? So these are the key levels, and these are the levels that for the longs to say, okay, well, I can go long here, but I can take profits just around, just below the resistance, which is, if the resistance is 44 or the target's 44, then you target 43.99 or 43.90. Okay, that's the way you look at it here. Until that, in my eyes, is really the third requirement of a green light, which is the CPI. And again, going back, just to summarize, look at the euro dollar. Once again, this is the same idea. Where is the next high? Would be 108. So even though it's a confluence of 100 and the 200-day moving average, it's looking 108, you consider 107.80, 107.90, okay? And that also is in line with an inverted head and shoulder. I'm going to speak just briefly about Bitcoin here. So because Bitcoin is breaking above 35,000, so it finally broke the inverted head and shoulder target, okay? So as you know, the inverted head and shoulder, if you take the difference or the distance between, let's say, 15,009 and the neckline, which is around 25, so it's around 9 to 10,000. 10,000 plus 25,000 is 35,000. So we clearly broke above it. So where would you go next? Well, instead of me going into the technical analysis and saying the weekly and where are we going to go next, is it 41, 42, and so on and so forth? I have a different approach, and this approach, ladies and gentlemen, is what has it done relative to gold? And again, this is a video that I've done in my own personal YouTube channel, but the idea is that here, do you see this? Ever since December 2020, almost exactly 3 years ago, whenever Bitcoin broke above 16 ounce per gold, it continued to go up and up and up. As it in here, when Bitcoin went to above 60 and it crashed and it fell hard in 2021, once it stopped at 16 ounce per gold, that 16 ounce per gold, its importance played the role of a key support, and it held the support and it went up, and then we came back down, and then we had the beginning of the bear market. And as we had the bear market, once we got to 16, that was the equivalent of 30,000. Okay, 30,000 Bitcoin. It was 16 ounce per gold, and as we went in here, we lingered. People said we're going to have a support at 30. Once we broke, we went all the way. But here is what's important. As we rallied, as we recovered last summer, everyone, including me, I thought that we're finally going to break 29 and we're finally going to go towards 35,000 target. But guess what? We didn't go. We went to around 31,000. Why? We never broke above 16. This time we clearly broke above 16. For more detail on this analysis, you can look at the video that I did here. Okay, it's a detailed video on 1 to 16 ounce ratio in my personal channel of YouTube. This video here, the first half of these videos, most of the videos are, first half is in English and the second half is in Arabic. So going back here, there is something else I want to show you. Maybe this is the time to get into also Ethereum. Because why? Because this is Ethereum divided by Bitcoin, or this is Ethereum versus Bitcoin. And as you can see, Ethereum has been falling hard along with the other coins against Bitcoin, but now it seems to be holding, it seems to have reached a support. If Ethereum itself has reached a key support against Bitcoin, then, and it is rallying, if Ethereum protects this support against Bitcoin, 0.05, maybe the time also is not only to get into Bitcoin, but to get into Ethereum, right? And if you look at a chart of Ethereum here, you will basically see the following. Yes, we're breaking above, some key resistance levels, but we're still below the low. We're still below the high of the year. Okay, Bitcoin has finally hit a new high for the year, Bitcoin, but not Ethereum. So probably in terms of, not immediate, but in terms of short-term upside, probably there's more short-term upside, almost immediate upside in Ethereum than in Bitcoin. So we are $1,895 per one Ethereum. We could be looking and targeting 2019, okay? And so basically we told you about the key levels in the S&P. For those who are wondering what about NASDAQ, then 15,000. So right now, as we're speaking, so basically the CFDs or cash, not the cash, but the CFDs right now are 15,130. So we've broken well above the trend line on the cash, okay? And it seems that we have broken above these key levels, so it seems really the next level is going to be 15,300, okay? That's just one thing about the dollar yen. It seems that the Bank of Japan never had to intervene, okay? And because it seems that yields have topped out. But according to the analysis that I showed you at the beginning of this video, maybe we have one more week of gains in 10-year yields. And if we do that, there is a chance for dollar yen to regain 150.50, okay? And again, I'm going to end this video with that important look at the cycles in yields. So this is the 10-year yield, and if you know that the 10-year yield is highly correlated to dollar yen and to the markets and to the dollar, if you look at these cycles here, okay? If you look at these cycles, that's basically an 89 to 90-day cycle, then you see that there is a high here, there's a high here, and it seems that probably the next high will be next week. So once we reach that high, that will be the equivalent of some sort of a new local low, not cycle low, local low in indices before we push higher. And this is it. We're going to have one more video this week on Wednesday, but I guess this will keep you informed ahead of the next 2 days. Thank you, and have a good one.